Mastering Your Money, A Guide to Personal Financial Planning. Chapter 7. Tax Planning and Optimization. Tax planning and optimization involve strategic measures to minimize your tax liability, while maximizing your financial benefits within the legal framework. As your personal assistant, I can provide you with a few key strategies to consider. 1. Take advantage of tax deductions and credits. Stay informed about tax deductions and credits available to you. These can include expenses related to education, healthcare, home office deductions, and energy-efficient improvements to your home. By leveraging these deductions and credits, you can reduce your taxable income. 2. Contribute to retirement accounts. Contributing to retirement accounts, such as an individual retirement account IRA or a 401k, can provide you with tax advantages. Contributions to traditional IRA letters and 401ks are often tax deductible, meaning you lower your taxable income for the year. Meanwhile, contributions to Roth IRA letters are not tax deductible initially, but qualified withdrawals are tax-free in retirement. 3. Optimize investments. Tax-efficient investing can help you minimize taxes on your investment returns. For example, holding investments for more than a year before selling them can qualify for long-term capital gains tax rates, which are often lower than short-term rates. Additionally, consider tax-advantaged investment vehicles, such as municipal bonds, which generate tax-free income. 4. Utilize tax-advantaged accounts. Explore options like health savings accounts HSA letters and flexible spending accounts FSA letters to reduce your taxable income and save on qualified medical expenses. HSA letters offer a triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. 5. Plan for charitable contributions. Charitable contributions can both support meaningful causes and provide tax benefits. By donating to qualified charitable organizations, you may be eligible for tax deductions. However, ensure you follow proper documentation and IRS guidelines. Remember, tax planning should be tailored to your individual circumstances. So, it's advisable to consult with a tax professional or financial advisor who can provide personalized advice based on your situation. 7.1. Basics of Personal Income Tax. Personal income tax is a system implemented by governments to collect revenue from individuals based on their income. Here are some basics to help you understand personal income tax. 1. Taxable income. Personal income tax is typically based on your taxable income, which is the amount of income you earn from various sources after certain deductions and exemptions. 2. Tax rates. Governments use a progressive tax system where different income levels are taxed at different rates. As your income increases, you may move into higher tax brackets, resulting in a higher tax rate applied to the corresponding portion of your income. 3. Deductions and exemptions. Tax laws often provide certain deductions and exemptions that reduce your taxable income, thus lowering the amount of tax you owe. Common deductions include expenses related to education, healthcare, and charitable contributions. 4. Filing requirements. Individuals who earn above a certain income threshold are required to file an annual tax return. This involves reporting your income, claiming deductions, and calculating your tax liability. 5. Withholding. Many employers withhold income tax from employees' paychecks on behalf of the government. The amount withheld is based on factors such as your income level and the information provided on a Form W-4. 6. Deadlines and penalties. Personal income tax returns are typically due by a specific deadline, often in April or May. Failing to file your return or pay the taxes owed on time may result in penalties and interest charges. 7. Tax credits. Tax credits are different from deductions, as they directly reduce your tax liability rather than just lowering your taxable income. Common tax credits include those for children, education expenses, and renewable energy investments. It's important to note that personal income tax regulations can vary between countries and even within different regions or states. For accurate information and guidance, consulting with a tax professional or using government resources is recommended. 7.2. Strategies to minimize tax liability. There are several strategies that can help minimize tax liability. Here are a few commonly used methods. 1. Take advantage of tax deductions and credits. Understand the deductions and credits available to you and make sure to claim them. This may involve itemizing deductions or utilizing tax credits for specific expenses such as education or energy-efficient home improvements. 2. Contribute to retirement accounts by maximizing contributions to retirement accounts such as a 401k or IRA. You can reduce your taxable income. These contributions may also qualify for tax deductions or provide tax benefits in the future. 3. Optimize your investment portfolio. Consider investing in tax-efficient funds or tax-advantaged accounts, like a health savings account HSA or a 529 college savings plan. These accounts can provide tax advantages such as tax-free growth or tax-deductible contributions. 4. Manage capital gains and losses. Be strategic about buying and selling investments to help minimize capital gains taxes. By offsetting capital gains with capital losses, you may be able to reduce your overall taxable income. 5. Consider your business structure. If you have a business, choosing the right business structure can have significant tax implications. Consult with a tax professional to determine whether a sole proprietorship, partnership, corporation, or other structure is most beneficial for your situation. 6. Plan charitable giving. Donating to qualified charitable organizations can result in tax deductions. Keep track of your charitable contributions throughout the year and ensure you meet the necessary criteria for claiming deductions. Remember, each situation is unique, and it is always advisable to consult with a tax professional who can provide personalized advice based on your specific circumstances. 7.3. Tax-efficient investing. Tax-efficient investing refers to strategies and approaches that aim to minimize the tax burden associated with investment activities. Here are a few key strategies to consider. 1. Tax-advantaged accounts. Utilize tax-advantaged accounts such as IRAs, 401ks, or Roth IRAs to benefit from tax advantages such as tax-free growth or tax deductions. 2. Asset location. Allocate investments strategically across taxable and tax-advantaged accounts. Generally, it is advisable to hold tax-efficient investments like index funds or ETFs in taxable accounts, while placing less tax-efficient assets such as actively managed funds or bonds in tax-advantaged accounts. 3. Tax loss harvesting. Take advantage of tax loss harvesting by selling investments that have experienced losses to offset capital gains. This can help reduce your overall taxable income in a given year. 4. Dividend considerations. Be mindful of the tax impact of dividends. If you are investing in taxable accounts, prefer investments with qualified dividends, which are taxed at lower rates than non-qualified dividends. 5. Long-term capital gains. If possible, hold investments for longer than 1 year to qualify for long-term capital gains tax rates, which are generally lower than short-term rates. 6. Tax-efficient investment vehicles. Consider utilizing tax-efficient investment vehicles, like index funds or ETFs that have lower turnover, resulting in reduced capital gains distributions. Remember that tax laws can be complex and subject to change, so it's always a good idea to consult with a qualified tax advisor or financial professional to tailor investment strategies to your specific tax situation. 7.4. Understanding tax deductions and credits. Tax deductions and credits are valuable tools that can help reduce your overall tax liability. While they both serve the purpose of lowering your tax bill, they differ in how they achieve this. 1. Tax deductions. Tax deductions reduce your taxable income, which in turn lowers the amount of income subject to tax. Deductions are typically subtracted from your total income before determining your tax liability. Some common tax deductions include standard deduction, a set amount that varies based on your filing status. It is a deduction available to all taxpayers, and you can choose to claim the standard deduction or itemize your deductions. Itemized deductions. These are deductions for specific expenses that you can claim instead of the standard deduction. Examples of itemized deductions include mortgage interest, state and local taxes, medical expenses exceeding a certain threshold, and charitable contributions. Above-the-line deductions. Certain deductions are deducted from your total income, even if you do not itemize. These deductions can reduce your adjusted gross income (AGI), and include items like student loan interest, educator expenses, or health savings account contributions. 2. Tax credits. Tax credits directly reduce your tax liability on a dollar-for-dollar basis. Unlike deductions, which reduce taxable income, credits are applied directly to the amount you owe in taxes. Some common tax credits include child tax credit, a credit provided to eligible taxpayers for each qualifying child, which has the potential to reduce your tax liability significantly. Earned income tax credit, a credit designed to help low to moderate income individuals and families. It provides tax relief based on income and the number of qualifying dependents. Education credits, credits such as the American Opportunity Credit and the Lifetime Learning Credit, are available for qualifying education expenses incurred by you, your spouse, or your dependents. Renewable energy credits. Credits are available for individuals who make energy-efficient home improvements or install renewable energy systems. It's essential to research and consult with a tax professional to understand which deductions and credits you qualify for, as eligibility can vary based on your personal circumstances and the current tax laws.